You're about to hand over a literal fortune to the ATO this fee. And it's happening completely on autopilot, without your explicit consent. If you're over 45, with more than $300,000 sitting in industry funds nuts, you're actively bleeding wealth right now. Remember, this is educational information, only to help you navigate this minefield. We're talking about an estimated $45,000 in pure tax penalties that you can legally claw back before the final 30th of June deadline ticks away. This isn't a joke, it's your hard-earned retirement lifestyle on the line. And the system is heavily rigged against anyone who doesn't take defensive action immediately. You've worked too hard to let poor administrative setups destroy your financial future, so pay close attention to every single detail today. Let's dive into the harsh reality of how your hard-earned wealth gets targeted by institutional gaps. General information only does not constitute personal financial, taxation, or legal advice. Look, if you're holding a significant balance in either industry funds or retail funds, you're likely being hit with massive unnecessary charges and totally incorrect threshold configurations. The first major issue relates directly to your concessional contributions cap, which stands at exactly $30,000 for the 2025 to 2026 financial year. Most high-income Australians mistakenly assume their employer's compulsory super guarantee contributions cover everything perfectly, but that's a dangerous financial assumption to make. If you're earning a strong salary, your employer's contributions leave a massive unutilized gap up to that $30,000 limit. By implementing a highly proactive salary sacrifice strategy, you can instruct your payroll department to redirect your pre-tax corporate income straight into your designated super fund. This reduces your taxable personal income down significantly, shifting your tax bracket from 37% or 45% down to a flat 15% internal fund tax rate. That's a massive wealth preservation play that smart operators use to secure their assets before the financial year ends. You can also make personal deductible contributions directly and claim them later, provided you lodge a formal notice of intent with your fund before tax time. This simple form is the key to unlocking massive tax relief. Yet thousands of Australians leave it completely blank every year, forfeiting their deductions to the government. The second technical pillar you must master before the financial clock strikes midnight is the dreaded Medicare Levy surcharge setup. If your personal taxable income exceeds the designated statutory thresholds and you don't hold the appropriate level of private hospital cover, the ATO will slap you with an extra surcharge of up to 1.5% on your entire income. For an individual earning substantial corporate revenue, that's thousands of dollars vanishing into thin air for absolutely zero practical return. You've got to align your private health insurance policies perfectly with the ATO guidelines before 30th June to escape this financial net. If you leave even a single calendar day uncovered during the financial year, you'll face a painful pro rata penalty that drains your cash reserves. It's an institutional trap designed to catch high earners completely off guard, and the only way out is absolute operational precision and immediate verification of your policy status. Let's stop right there because this is getting incredibly critical for your long-term financial survival. If you've felt the stinging pain of paying too much tax or feel completely overwhelmed by these complex rules, drop a comment below right now with your biggest financial pain. Tell us exactly what's draining your investment energy this financial season so we can tackle it together. Now, let's unlock the remaining technical secrets to fully insulate your capital from government overreach. We absolutely have to talk about the brutal reality of the Division 293 tax threshold. once your combined income and concessional super contributions surpass $250,000. The ATO triggers an additional 15% tax on your super contributions. This effectively doubles your tax rate inside the fund from 15% to 30%. It's a massive, targeted blow to high net worth individuals trying to maximize their retirement nest egg. If you aren't actively monitoring your total superannuation balance and adjusting your contribution styles, you'll get a surprise bill from the ATO months after filing your annual tax return. This brings us directly to a silent killer that ruins thousands of strategies every single June, a phenomenon we call the BPA death trap. Most Australians think that making a voluntary contribution via BPA on 29th June means they're safe. Wrong! It's a total financial disaster. The ATO rules specify that contributions only count for the current financial year if the money is actually received by your super fund before the close of business on 30th June. If you process a BPAY transfer late, financial institutions can take up to 3 business days to clear the transaction. That means your hard-earned capital sits in limbo, missing the deadline completely, and your tax deduction is lost forever. Your money counts toward the next financial year's cap instead, potentially triggering excess contribution penalties if you aren't careful. It's a brutal mechanism that turns a smart tax strategy into an absolute administrative nightmare for your wealth portfolio. You must never trust standard bank processing times during the final week of June, as any delay will completely break your financial alignment and cost you thousands in lost opportunities. The ultimate high-value insight to maximize your position revolves around the 5-year carry-forward provisions. If your total superannuation balance was below $500,000 at 30 June of the previous financial year, you can legally access unused concessional caps from the past 5 years. This allows you to inject significantly more than the standard $30,000 cap into your super before this end of financial year ends. For an executive or professional in the top marginal tax brackets, this single maneuver can wipe tens of thousands of dollars off your taxable income profile, creating an instant cash saving that stays in your family asset pool rather than funding government departments. You must log into your MyGov portal immediately, inspect your available carry-forward caps, and coordinate with your fund manager to execute the transaction safely before the BPI death trap snaps shut on your wealth. It's the single most powerful tool for high-net-worth individuals to catch up on wealth creation and secure an extraordinary tax offset before the financial gate closes tight. As we wrap up this urgent tactical briefing, remember that timing is absolutely everything in elite wealth management. General information only does not constitute personal financial, taxation, or legal advice. If you're ready to stop bleeding cash and want to master the elite strategies that safeguard your hard-earned capital, make sure you don't miss our next broadcast. We'll be exposing the hidden fee structures within prominent retail funds that are silently eating your profits from the inside out without your knowledge. Hit that subscribe button to Aussie Super Secrets right now, turn on notifications, and secure your financial future before the government takes what's rightfully yours. See you in the next episode, stay smart, and keep your wealth protected. Disclaimer: the information provided in this video is for general educational purposes only and does not constitute financial, taxation, legal, or home loan advice. It has been prepared without taking into account personal objectives, financial situation, or needs. Before acting on any information, it is recommended to consider its appropriateness and consult with a licensed professional, such as a financial planner or tax agent. Specific results or future performance are not guaranteed. 2026 Aussie Super Secrets. All rights reserved.